as I told you before, the presence of algorithms is overwhelming, and especially in some markets, it goes above 80%, which markets the futures markets. So over 80% and growing could be 85, 90% in 2014. When it comes to options, there is an estimate. I have 2010, 20% of volume moved by algorithms. Forex, which is very important to us, 25% estimated in 2006 and believed to be 45% between 2010 and 2014. So it could possibly be higher. And then there is the monster, the class of high frequency trading, which is estimated on equity to be between 35% to 75% of the European and North American equity markets. So that's huge. Now, the effect of high-frequency trading is different from the effect of program trading, which is another class that is said to be responsible between 20 and 30%. And this class is quite important because it's not like high-frequency trading that acts very quickly and with a big turnaround. This class acts very slowly on daily and weekly time frame, and I believe it's responsible for trading, for trends, and keeping the trends active. And you have sources here. So my question for you is: are you still sure you want to keep using only traditional methods and tools, knowing that modern markets are totally different? So what we know for sure in the markets, and I am reconnecting here to that point of my philosophy, which is I only use proved and grounded concept in my trading. So what is really true about the market? Only a few things are true. One of these is existence of trend, and we know that visually as well. We don't need a big confirmation for this. Now, I'm not going to define what is a trend, that it's higher highs and higher lows for uptrend, and the opposite for downtrend. And this is a concept that was introduced by Daddy, our granddaddy Dow Jones back in the 1900s. So and a little bit before actually. So this aspect of the markets can be proven formally, and here is the research if you're interested. But another thing that is true about the market, other things that are true about the market are related to algorithms, and we know that there are algorithms and HFT trading in the markets, and I show you the figures as well. And I have also a proof, a observable proof that these algos impact setups and participate at relative swing and low highs, and are able to define and maintain trends in modern markets in certain conditions. When there are no news, no planet news, when there is no intervention from the central bank, when there are no geopolitical huge events, in those conditions, algos are stopped, and then they easily and quickly readjust to the situation in few hours or a few days. So they still make an impact also when there are these huge events. So let me show you an example now very, very quickly. And also in this example, I'll show you also why, and this is only an example, but why self-fulfilling prophecy are not responsible. Self-fulfilling prophecies on technical analysis are not responsible for durable and big participation in the market. So what you see on the screen is the 4-hour chart of the euro dollar. And I have a number of levels and areas mentioned here. Now, the way I look and model algorithms is through a special use of Fibonacci. I'm not going to go down to details here. There is a nice webinar I gave back, I believe, in March. It's one of the first webinars in which I spoke about the Fibonacci. It's a critique of Fibonacci and how actually what are the Fibonacci number are used. So in this case, when we trace from, let me see if I can annotate this. Well, unfortunately I cannot. Yeah, probably I can. So I trace from the low in A to the high in B, and we get this participation here, the 50%. And I also have 1 and 2 targets here. The market gets into D and then into E. and then continues higher. And we know now that this market is extended, and we use another technique to identify this F. I trace from B to X. So as you can see, it's a very different way of using Fibonacci. Now the market gets into the first target of this new trace, but never makes it into the second target, but ends up at Y. And then there is this nice bounce from the 20-day moving average. I don't use, as I mentioned before, I use no indicators. I'll show you later on my charts. I have no indicators in them. So here we have a reaction and the sitting duck level here, whereas there is a reaction on top of this 20-day moving average. But see, the market had to come anyway into the next area of support before a sensible move could happen. Can you see this? These levels are actually fake. So what happened here is that when the market got into the 20-day moving average, there was, of course, participation there, but the market actually went higher and then had to retrace into the next area where participation from program trading is expected. So this is a simple example, and I can show you plenty of this on trend lines, on the use of bands, you name it, and you will see these kind of things all the time. You'll say that the signals is too early or too late, but it never coincides, or very, very rarely coincides with the area where there is participation from program trading. So let me show you a most recent example here on the euro versus the Canadian dollar. And here the situation is the same. Let me see if I can annotate. If I can, I'll do that. Otherwise, I'll explain this. So I'll explain this chart. This is the daily chart of the euro Canadian dollar. It's a recent price starting from March here. A is in March. When I trace from A to B, I get C, and this is an entry point in the trend. Now, I don't usually trade this level blindly. I always use a technique which I call FibStalking technique. It's a way to procedurally test these areas. In this case, this is an area of resistance. The price went down into first and second target. Again, I cannot annotate here. First and second target D and E, and actually went lower into F. And then again, when I trace from B to F, I get this G point here. Again, another good area to get short in the markets here. And I went into H and I, and then just below that. Now notice how nicely when the market gets into this targets here, there is always a reaction that is profit taking. We are seeing it here, and then of course we see a lot it here. Now when the market gets and breaks the next setup, that's a violation of the whole sequence down here, and that's the reason why we are seeing this market moving higher.